The Vancouver real estate market may already be crashing, according to our next guest. For perspective, we're off to Vancouver to speak with Leopold Evans, Group Senior VP and Portfolio Manager. David Leopold Evans joins us now. Good to have you with us.
Hi, Michael.
So this is quite the incendiary statement that you've been making over the past few days.
Hold it. Let's back up a second. Somewhere we got lost in translation. I've never said that it may be crashing. I said the top may be in and it may be slowing. Before we start, I just want to say that I work with National Bank Financial, Leopold Group, but we do our own research.
Right.
So this doesn't necessarily reflect the views of National Bank of Canada. These are Leopold Group views.
So then give us a sense as to what makes your view that we have hit that top. If we're not crashing, that we've hit the top.
There's a good chance we may have hit the top. So let's look at what's caused the run up in prices. And you know, if we first of all, we have to determine, is it a bubble? And I would say that that's the easy determinant. You would pay about $2 million for a house that would rent about $3,000 a month. Well, a price earnings multiple, if we looked at it like a stock, a price earnings multiple, that's 75 times earnings, let alone your property taxes and your upkeep on the place. So you're north of 75 as a price earnings multiple. People get nervous if we talk about 18 times on the stock market, as you know. So, you know, the valuations are a stretch and you know, obviously a lot of work has been done on price to income, price to rents, and they're off the charts. So what's caused the run up in prices? Well, cheap and available credit. And of course, it looks like credit's going to stay cheap for a while longer. Number two is foreign capital flows, which are outsized certainly in Vancouver, mostly from China. And number three is something that we learn in financial markets is the trend is your friend. The more a trend is in place, the more investors are convinced of its permanence and the more participation you get in that trend. Once the trend reverses, though, you know, one has to be careful. So, you know, my thinking on the fact that the market may have peaked is the fact that the February, March, April numbers were off the charts. And, you know, if we look at the numbers for June, the sales numbers were off quite a bit and they're way down from the last couple of years. So we're starting to see something, if you drive around Vancouver, you haven't seen in a long time, for sale signs. I mean, the market was so hot, a sold sign would go up before the for sale sign.
Okay, but having said that, if you want to maintain that sort of metaphor of equities, there would be the technical analysts who would also argue that while the trend may be your friend until it ends at the bend, that when you see that down tick, we don't have enough data points yet to know whether or not it's a downward trend or whether it's just a sideways base. And the longer the base, the better the case for more upward movement.
Michael, you may absolutely be right, but one of the three things that I mentioned on the bubble, foreign capital flows, we may be seeing the end of that flow. And on one side of the equation, a lot of you've been talking about on BNN for weeks now, is should something be done about that? Well, on the other side of the ocean, the Chinese are trying to do something, and looks like they've tripled their efforts. I mean, Bloomberg News is reporting that they're now jailing people for money wires. That never happened before.
So the Chinese component,
you know, that's your fuel. Your fuel is impaired at this point.
But we don't know how much fuel really is coming courtesy of the Chinese. The data is still anecdotal at this point, and even unless you saw the Chinese ordering their locals to withdraw cash, wouldn't that just sort of, again, bring us back to that sideways movement as opposed to an apex that leads to a downward swing?
Well, Michael, as we know, like bubbles, the last move in any market that gets bubbly is the biggest. I mean, look at oil, you know, going to 147 recently, the last few years, before it crashed. We look at gold in the late 70s. The move from 600 to 850 happened in the last 2 weeks of the gold bull run. We look at the NASDAQ, where yours truly began to sell short tech shares in January of 2000. The NASDAQ was at 4,000. By April, it was at 5,000. So it had gained 25% in 4 months. The last move is the big move. And, you know, as Kyle Bass talks about in The Big Short, you're in trouble in a bubble when prices stop going up. part of the fuel of easy credit is rising prices. And if prices have leveled off, that's when you're going to start to say, Houston, we have a problem.
But I wonder if we've got the circuit breakers to sort of maintain your Houston, we have a problem metaphor, as that was one of the issues.
Yeah.
Is that the driving price forward has largely been because of constrained supply and strong demand. If you pull back on the cash coming into that market specifically, would that not be taken up by the locals who still want to get into the market? You take 20% off the value of a house in Vancouver, that's just going to make it that much more affordable for someone who lives locally.
Well, let's remember home ownership in Canada is at a record high, and it's north of 70% home ownership. You can only get so many people into the housing market. So we're already at record highs of home ownership. I don't know. I don't know how many more people can own a house.
David, we appreciate your perspective. Thank you for joining us.
Oh, cheers. Okay.
David Lapotvin is the Vice President and Portfolio Manager at Lapotvin Group at National Bank.